Right now, trillion-dollar markets are settling on promises that only work when nothing goes wrong. But within every 24-hour market cycle, those promises are breaking. Tariffs, capital controls, and delivery failures are shattering the system in real time. And while gold, banks, and exchanges are quietly changing their own rules just to survive, one network keeps settling, block after block, without permission. And when settlement breaks, it doesn't break on TV. It breaks on Monday morning, when the trade has to clear. This isn't about speculation. It's about the only settlement layer that doesn't fail under stress. When most people hear Bitcoin, they think of crazy price swings, speculation, and a digital casino. That view completely misses the point. It's like looking at a revolutionary new engine and only complaining about the noise. The real story, the one that big money investors and even central banks are now forced to get, isn't about getting rich quick. It's about the fundamental pillar of our economy: final settlement. We are conducting a financial autopsy, not on a system that might fail, but on one that is failing now. Settlement failures don't announce themselves. They show up at clearing time. We're going to open the hood and show you where it fails. Then I'll show you what doesn't. This isn't a story about price. It's a story about purpose. When most people hear Bitcoin, they think of crazy price swings, speculation, and a digital casino. That view completely misses the point. It's like looking at a revolutionary new engine and only complaining about the noise. The real story, the one that big money investors and even central banks are now forced to get, isn't about getting rich quick. It's about the fundamental pillar of our economy: final settlement. We are conducting a financial autopsy, not on a system that might fail, but on one that is failing now. Settlement failures don't announce themselves. They show up at clearing time. We're going to open the hood and show you where it fails. Then I'll show you what doesn't. This isn't a story about price. It's a story about purpose. To understand why Bitcoin is the solution, you first have to understand the thing it's disrupting: settlement. When you buy a coffee, settlement is dead simple. You hand over cash, you get coffee. The deal is final. But in high finance, where millions or billions of dollars in stocks, bonds, or gold are flying around, settlement is a fragile, multi-day ordeal. It's the last step where ownership is officially and irrevocably transferred. That key word is irrevocable. This is called finality. True finality means the transaction cannot be reversed or clawed back. It's done. The other term you need to know is counterparty risk. That's the persistent fear that the other person in your deal won't hold up their end. They don't have the money, or they don't actually have the asset. The entire traditional financial system is a complex web of trusted middlemen, clearinghouses, custodians, banks, all trying to manage this risk and ensure the deal eventually settles. For centuries, the ultimate settlement asset, the bedrock for this entire system, has been gold. It's tangible, recognized everywhere, and exists outside any single government's direct control. When countries settle massive debts, the final, ultimate payment has historically been physical gold bars moving from one vault to another. This system's survival depends on two things. First is physical delivery. The paper contract for gold is only good if it's backed by real metal in a vault, managed by places like the London Bullion Market Association, LBMA, or COMEX. The second is arbitrage. If gold in London is cheaper than in New York, traders buy it in London, ship it, and sell it in New York for a profit. This keeps the price of gold the same everywhere and keeps the system honest. A paper claim on gold is worthless without the ability to move the physical metal. This is where the system breaks down. The system we assume is rock solid is actually fragile. It works until it doesn't. And now, it is showing deep structural fractures. Fracture number 1, the death of arbitrage. The global price for gold relies on it moving around without friction, but governments are creating that friction. A country imposes sudden export restrictions, emergency taxes, or other political penalties that make moving metal prohibitively expensive. Suddenly, the arbitrage trade is dead. Prices in different locations are no longer linked. You get one price for gold in London and a totally different one in New York. Hedging strategies fall apart. The problem is, a settlement system that can be held hostage by politics is not reliable. Bitcoin, on the other hand, settles on a single global ledger. A block is a block, whether it's confirmed in New York, London, or Tokyo. It sidesteps physical geography and political borders completely. Fracture number 2, the one-way valve of capital controls. An asset is only useful for settlement if you can move it when you need to. But governments have a long history of trapping assets inside their borders with capital controls. In 2013, Cyprus limited bank withdrawals to a few hundred euros a day. China has periodically restricted capital from leaving the country. India has put strict curbs on gold imports. Argentina has ongoing restrictions. In every case, you own the asset on paper, but you've lost control over it. You now need permission to move what is yours. An asset you need permission to use is not a settlement asset. It's a liability controlled by a custodian who can say no. Bitcoin, as pure information, isn't bound by these physical chains. As long as you have an internet connection, a transaction can be broadcast from anywhere to everywhere, ignoring the artificial borders designed to trap wealth. Fracture number 3, delivery failures and bending the rules. The promise of a futures contract is that you can take physical delivery. In March 2020, that promise shattered. As the pandemic shut down global travel, flights were grounded and refineries closed. It became almost impossible to get the right kind of gold bars to the right vaults in time for COMEX delivery. The system faced a massive default. But instead of failing, the rules were changed mid-crisis. In a highly unusual move, COMEX decided to allow 400-ounce London bars to be substituted for the standard 100-ounce US bars to prevent a meltdown. Think about that. The fundamental rules of the market were changed on the fly to avoid a collapse. It's a referee changing the rules in the final minutes just to make sure the home team wins. It guts the very trust the system is built on. A robust settlement system cannot have its rules changed by a committee in a panic. Bitcoin's rules are enforced by code and consensus. They cannot be bent to save someone. A transaction is either valid or it's not. Fracture number 4, cash settlement, the ultimate letdown. The final admission of failure for any physical asset contract is cash settlement. This is when an exchange, unable or unwilling to deliver the physical good you're owed, just gives you the cash equivalent instead. It happened in 2022 when the London Metal Exchange, LME, halted nickel trading and canceled trades during a massive price spike. We saw it in 2020 when oil futures went negative because there was nowhere to store the oil, forcing traders to pay people to take it. In those moments, the promise of ownership is exposed as nothing more than price exposure. You thought you owned a claim on a real thing, but you really just owned a financial instrument that could be forcibly turned into cash at the worst possible moment. This is the ultimate failure of settlement. Bitcoin either settles, meaning the digital asset is transferred on-chain, or the transaction fails. There is no emergency clause to cash settle a Bitcoin transaction. The asset is the settlement. These fractures are symptoms of a deeper problem. Our global settlement system is built on layers of trust, geography, and permission that are crumbling under 21st century pressure. So if the old foundation is cracking, what does a new one need? The perfect global settlement layer has to be fast, secure, and completely trustless, meaning no middlemen. Traditional systems force you to choose 2 out of 3. A wire transfer is secure and uses trusted banks, but it's not fast. It takes days. Physical gold is trustless in your hand, but it's painfully slow and risky to move. This is where you must stop thinking of Bitcoin as money for buying coffee. That's a secondary application, like the Lightning Network. The main Bitcoin network is a competitor to systems like Fedwire or Swift, a global, neutral, unstoppable network for final settlement. In recent years, the Bitcoin network has settled a cumulative value in the trillions of dollars, with daily volumes often in the many billions, a scale that puts it in the conversation with major global payment systems. It pulls this off with three unique properties that old systems cannot match: absolute scarcity and predictability. There will only ever be 21 million Bitcoin. The creation schedule is set in stone and cannot be changed. No government or central bank on Earth can offer that kind of predictability. Decentralization and censorship resistance. The Bitcoin network is run by tens of thousands of computers all over the world. There's no headquarters to shut down, no CEO to call, and no committee to change the rules in a crisis. If a transaction follows the rules of the code, it gets processed, period. Irrevocable finality. This is the magic ingredient. In the banking world, a transaction can look final, but be reversed days or weeks later. In Bitcoin, finality comes from proof of work. Once a transaction is in a block and a few more blocks are built on top of it, usually about an hour, it becomes mathematically impossible to reverse. It would take an insane amount of computing power and energy. This gives you mathematical certainty, not institutional promises. Now for the aha moment. Let's compare a huge international settlement, the old way versus the Bitcoin way. Consider a European bank needing to settle a $500 million debt with an Asian bank using gold. It's a logistical nightmare. Lawyers verify the deal, the gold bars have to be audited, then they're scheduled for secure transport, armored trucks, cargo planes, more armored trucks. It involves countless middlemen, insurance, customs, and regulators. The whole thing takes days or weeks, and it's exposed to every fracture we just talked about. Now, picture the same settlement with Bitcoin. The European bank creates a transaction, sending $500 million worth of Bitcoin to the Asian bank's public address. They broadcast it to the network. Within 10 minutes, it's in a block. Within an hour, it's considered permanently settled. The funds have crossed the globe with no middlemen, no cargo planes, no custodians, and no permission needed. The settlement is final, public, and done. That's the revolution. Not the price, but the purpose. A global, apolitical, and tough-as-nails system for settling large amounts of value. If you're getting value from this look behind the financial curtain and want to understand the real why behind these technologies, go ahead and subscribe to the channel. We skip the hype and get straight to the fundamentals. This brings us back to the main point. Bitcoin is a settlement layer, not just a get-rich-quick scheme. The daily price noise that the media obsesses over is a distraction. It's the messy process of the market figuring out what this new invention is worth. The real signal isn't the price. It's the fact that the network has been running 24/7 for over a decade, producing a new block every 10 minutes, and settling transactions no matter what. It's also critical to understand the difference between owning Bitcoin itself and owning a financial product that says it's Bitcoin. The spot Bitcoin ETFs are a huge step for making it easier for people to get exposure. But an ETF share is a custodial claim. You're trusting a company like BlackRock or Fidelity to hold the actual Bitcoin for you. While these are regulated and trusted firms, they reintroduce the very middleman risk Bitcoin was made to eliminate. You own a share, a promise, not the asset itself. You cannot take custody of your ETF shares or use them on the Bitcoin network. Futures contracts are even one step further removed. They are typically cash settled, meaning you're just betting on the price. These are financial tools, but they don't give you access to Bitcoin's core superpower: final, non-custodial settlement. Owning the actual asset and holding your own private keys is the only way to truly step outside the system of trusted middlemen. Here's how it all connects. The gold system fails when it cannot be physically moved. The banking system fails when trust disappears. The derivatives market fails when the promise of delivery is broken. Each of these is built on assumptions that are proving to be fragile. Bitcoin's system is built on math. It doesn't need to be moved, only verified. It doesn't require trust, only cryptographic proof. That's what makes it so resilient. It keeps working precisely when other systems start to crack. If you're getting value from this look behind the financial curtain and want to understand the real why behind these technologies, go ahead and subscribe to the channel. We skip the hype and get straight to the fundamentals. Our financial autopsy is complete. We've seen the hidden cracks in our global settlement system, a system failing under the weight of geography, politics, and the flimsy nature of trust. We've seen how that leads to broken markets, trapped money, and empty promises. And we've seen the blueprint for a new foundation, a system based not on trusted middlemen, but on decentralized code. Not on permission, but on mathematical proof. Gold fractures at the border. Financial contracts fracture at delivery. Bitcoin doesn't fracture at all. Bitcoin's biggest innovation isn't its price, it's its purpose. It gives the world something it's never had, a truly global, neutral, and censorship-resistant layer for final settlement. As institutions and even nations grasp this, the conversation is shifting from speculation to infrastructure. The focus is moving from Bitcoin as a volatile toy to Bitcoin as a global settlement network. So the real question isn't what will the price of Bitcoin be next year? It's what happens to the global financial system now that the world has access to an incorruptible settlement network that's open to everyone? The implications are staggering. Thanks for sticking with me on this deep dive. If you want more analysis that goes beyond the headlines, make sure you're subscribed. See you in the next one.